Imagine it's 2019. You own a glass and steel skyscraper in downtown Manhattan, the kind with a lobby that smells like expensive coffee and ambition. It's valued at $1 billion. Banks love you. Cities love you. Everyone assumes this thing will print money forever. Fast forward to now. Walk inside, the lobby is quiet. The elevators feel bored. Half the lights are off, like the building itself is trying to save on utilities. The workers didn't quit. They just didn't come back. This is the Zoom shock. For decades, companies treated office workers like parts in a factory. Max efficiency, just-in-time scheduling, no extra space, no Slack, no backup plan. Then one virus showed up and said, "What if we just didn't do that?" Zoom didn't just change meetings. It broke the entire logic of office real estate. Turns out, if people can do the same job from a couch, a kitchen table, or a spare bedroom in New Jersey, that billion-dollar tower is suddenly optional. And once companies realized this, they couldn't unsee it. Why pay for marble lobbies and downtown rent when Slack works from anywhere and pants are no longer mandatory? The real problem wasn't work from home. The real problem was how fragile the system was. Office buildings only work when they almost full. Drop occupancy from 95% to 65%, and the math collapses fast. The rent doesn't cover the debt. The debt doesn't care about your feelings. This wasn't a slow trend. It was a cliff. And the worst part, everyone pretended it was temporary. 2 weeks, just one more quarter. Everyone will come back. They didn't. And that's when the real trouble started. So now, the building is half empty. But on paper, everything is asterisk, fine asterisk. This is where the magic trick begins. Banks are not big fans of bad news, especially when that bad news says, "Hey, that $800 million loan you gave out, yet it's not worth that anymore." If banks marked these office loans to reality, they'd have to admit massive losses, and admitting losses means raising capital, cutting bonuses, and having very uncomfortable meetings. So instead, they chose the oldest trick in finance. Asterisk, asterisk, extend and pretend. Asterisk, asterisk, the loan is supposed to be paid back. Let's extend it. The building isn't generating enough rent. Let's pretend it will soon. This is how zombie loans are born. Not alive, not dead. Just wandering around. It already happened with housing after 2008. Now it's happening again, just with nicer elevators. On balance sheets, these buildings still look valuable. In real life, they're empty shells with Wi-Fi. Everyone knows it. No one wants to say it first, because the moment someone blinks, the entire game collapses. And trust me, this game cannot go on forever. Here's the part nobody likes to talk about at dinner. Office buildings are not valued like houses. They're valued like vending machines. Not by how nice they look, not by how tall they are, but by how much cash they spit out every month. Rent goes in. Debt gets paid. Investors smile. Now, take away the rent. Suddenly, that billion-dollar tower isn't worth $1 billion anymore. It might be worth $600 million, or $400, or, in some cases, less than the loan attached to it. That's the cliff. And once you go over it, there's no climbing back up. This is where owners panic, because if they sell, the loss becomes real. And if the loss becomes real, the bank has to admit it. And if the bank admits it, regulators start asking questions. So nobody sells. Buildings just sit there, empty, quiet, technically operating. It's like keeping a broken car in your driveway because selling it would force you to admit it's broken. The math gets uglier every year. Leases expire, tenants downsize, refinancing comes due. And interest rates. They didn't just rise, they kicked the door in. Loans that once cost 3% now want 7 or 8. That alone can double the annual debt payment, meaning even buildings that are half full still can't make the numbers work. This is the gravity trap. Once cash flow drops below a certain point, the building can never escape. And here's the scary part. These buildings are everywhere, in every major city, on the books of regional banks, which means this isn't just a real estate problem anymore. It's a balance sheet problem. This is where the problem escapes, the spreadsheet, because office buildings don't exist in a vacuum. They are the engine of downtown life. When workers disappear, everything else follows. Start with lunch. No workers means no sandwiches sold, no coffee lines, no after-work drinks. That corner deli that survived for 20 years, gone. The dry cleaner, gone. The guy who somehow made a living selling $4 pretzels, definitely gone. Now the city feels different. Less foot traffic, more empty storefronts, more shadows where people used to be. Then the tax problem hits. Office buildings pay massive property taxes. Workers pay income taxes. They also pay sales tax, transit fees, parking, everything. Take away the workers, and the tax base collapses quietly. Cities don't go bankrupt overnight. They rot slowly. So what do cities do? They cut services. Transit gets worse. Trains feel sketchier. Buses run less often. Police response times stretch. Maintenance gets delayed. Streetlights stayed broken just a little longer. And this is where the loop completes. Workers look at downtown and say, yeah, I don't really miss that. Companies notice their employees don't want to commute, so they shrink office space even more, which makes downtown emptier, which reduces tax revenue again, which makes services worse. Again, that's the urban doom loop. It feeds on itself, and once it starts, it's brutally hard to stop, because fixing it requires money. And the whole problem is that the money's gone. Downtowns were designed for density, for crowds, for momentum. Take that Hawaii, and the system doesn't gently adapt. ITA breaks. And we haven't even reached the banking part yet. This is where things get spicy. Big Wall Street banks, they dabble in office real estate. They diversify. They can survive a bad bet. Regional banks are a different story. They live on commercial real estate. Local office buildings, local apartment blocks, local shopping centers. It's boring. It's stable, or at least, it used to be. If you're a regional bank in Ohio or Texas or California, that shiny office tower downtown isn't just a building. It's collateral. It's retirement money. It's half your loan book. So when office values fall off the cliff, regional banks feel it first, and they feel it hardest. Remember those zombie loans? The ones being extended and pretended. Yeah, those are sitting right here. On paper, everything still looks okay. Loans are performing. Buildings are stabilizing. In reality, the bank knows they know the borrower can't refinance. They know the building isn't coming back. They know if they foreclose, they'll be stuck holding an empty tower no one wants. So they stall. They kick the can. They hope rates fall. They hope workers return. They hope something saves them. Hope is not a strategy. And here's the nasty feedback loop. As banks get nervous, they stop lending. No new loans, no refinancing. No credit for small businesses downtown, which makes downtown weaker. Which hurts buildings more, which hurts banks more. Trapdoor open. This doesn't explode all at once. It leaks. One bank fails quietly, another gets merged. Another gets a friendly weekend rescue. The public is told it's isolate, contained, totally normal. It never is. At some point, every investor asks the same question. Okay, how do I get out? And that's when the silence hits. Office real estate used to be easy to sell. Pension funds loved it. Insurance companies loved it. Foreign investors loved it. Big, boring, predictable cash flow. Now, nobody wants to be the last one holding the keys. If you try to sell buyer's lowball, you hard. They know you're trapped. They know refinancing won't work. They know time is not on your side. So owners face three bad choices. Sell and lock in a massive loss. hold and bleed cash every month, or hand the keys back to the bank and walk away. That last option is happening more than people realize. This is called jingle mail, because you mail the keys and stop answering calls. It's not illegal. It's not dramatic. It's just business math. But when enough owners do it, banks suddenly own a lot of very empty buildings, and banks are terrible landlords. They don't know how to revitalize downtowns. They don't know how to attract tenants. They don't even want the buildings. They just want the problem gone. But here's the twist. There is no someone else. No wave of new buyers. No sudden office revival. No return to work miracle. Remote work didn't kill offices completely. It killed excess offices, and there were a lot of them. This is what a system with no exit looks like. Everyone stuck. Everyone waiting. Everyone hoping someone else blinks first. No bodidos. When markets freeze, governments get nervous. Empty downtowns look bad. Bank stress looks worse. And politicians hate problems they can't ribbon cut. So the policy panic begins. First comes denial. This is temporary. Workers are coming back. Downtowns always bounce back. They don't. Then come incentives. Tax breaks for office conversions. Subsidies for revitalization zones. Grants for mixed-use dreams that look great in slide decks. The problem is scale. Converting an office tower into housing sounds nice. Until you try it. Floor plates are wrong. Windows don't open. Plumbing is in the wrong place. The math still doesn't work. Only a small slice of buildings can be converted. The rest are stuck as they are. Then comes pressure. Return to office mandates. Public sector workers ordered back downtown. Companies nudged, hinted, quietly threatened. It helps a little. It never fixes the core issue. Because you can't legislate demand. People tasted flexibility. They're not giving it up easily. Meanwhile, governments face their own math problem. Lower tax revenue, higher social costs, higher interest rates on public debt. So they borrow more, which buys time, not solutions. This is the policy trap. Do nothing, and downtowns decay. Do something, and you spend money you don't have. Either way, the clock keeps ticking. At first, everyone treats this like a city issue. New York problem, San Francisco problem, downtown problem. Nice and contained. Very comforting, except it isn't. Commercial real estate is everywhere. And so are the loans tied to it. Pension funds in Florida own office towers in Chicago. Insurance companies in Europe, finance buildings in Los Angeles, regional banks in the Midwest hold loans on towers in coastal cities. This is what financial people politely call interconnected, which is a fancy way of saying, if this goes bad, it goes bad everywhere. As office values fall, losses don't stay local. They hit retirement funds. They hit insurance balance sheets. They hit municipal bond markets. Suddenly, it's not just about empty lobbies. It's about whether pensions can meet payouts, whether cities can roll over debt, whether banks trust each other's balance sheets. And when trust goes, things move fast. Lenders pull back. Markets freeze. Everyone starts hoarding cash. You've seen this movie before. It never starts with panic. It starts with caution. A little less lending here. A delayed project there. A wait-and-see mindset everywhere. Economic growth slows quietly. Then all at once, the irony is painful. Office towers were built as symbols of strength, progress. Modern economies, now they're anchors. Heavy, hard to move. Dragging everything down with them. And here's the uncomfortable truth. No bailout fixes demand. No stimulus creates workers who don't want to commute. No speech can force a cultural shift to reverse. This isn't a crash you see on a chart overnight. It's a grind. Slow, relentless, systemic. This is the part where everyone gets tired and starts lying to themselves. You'll hear it on TV, in earnings calls, in very confident headlines. Green shoots, Stabilization. Early signs of recovery. This is what hope sounds like when data is awkward. Yes, some offices refill a little. Yes, a few companies call people back 3 days a week. Yes, foot traffic ticks up compared to rock bottom. And none of that fixes the math. A building that was designed for 2019 occupancy does not magically work at 2026 demand. A loan sized for zero interest rates does not behave nicely in a high-rate world. The recovery narrative focuses on vibes. The problem lives in spreadsheets. Leases signed today are shorter. Tenants demand flexibility. Rent growth is weak or negative. Meanwhile, debt maturities keep coming. This is the quiet killer. Loans written 10 years ago are rolling over now, and refinancing means facing reality. Lower valuations, higher rates, more equity required. Most owners don't have that cash, so the recovery turns into a reshuffle. The strongest buildings survive. The newest towers get tenants. Everything else gets left behind. This isn't a rising tide. It's musical chairs, and there are fewer chairs than buildings. The media will keep calling this a turnaround. Politicians will keep pointing to isolated wins. Markets will keep hoping the worst is over. But underneath all of it, defaults keep stacking up. Losses keep spreading. Downtowns keep thinning out. The system isn't healing. It's accepting a smaller version of itself. And acceptance looks a lot like decline when you were built for endless growth. Here's the part most takes miss. This isn't the end of cities. It's the end of asterisk. Asterisk, how we design them. Asterisk, asterisk. The office tower death spiral doesn't wipe everything out. It just punishes anything built on one fragile assumption that workers would show up 5 days a week, forever. Some buildings will survive, the newest ones. The ones near transit that actually works. The ones flexible enough to adapt. They'll fill up. The rest won't. They'll linger as half-empty shells, waiting for conversions that never pencil, waiting for buyers that never arrive. Cities will shrink inward. Downtowns will get smaller, tighter, more expensive per square foot. The dead zones will spread quietly around the edges. Regional banks will change to some will fail. Some will merge. Some will quietly unload bad loans over a decade. It won't be dramatic like 2008. No single crash day, no iconic headline, just a long period of underperformance, lower growth, and fewer big bets. And this is where the "I told you so" lands. The system wasn't strong, it was optimized. Optimized for efficiency, optimized for leverage. Optimized for a world where nothing ever changed. Then something changed. Remote work didn't break the system. It rebuilt. Italiano office towers didn't die because people are lazy. They died because the margin for error was zero. So when you see an empty skyscraper, don't think of it as a failure. Think of it as a fossil, a monument to a belief that felt permanent right up until it wasn't. And that's the real lesson of the death spiral. Not that downtowns are doomed, but that systems built without slack always are.